Hi everybody, this is Lara with your end of the week video for the S&P 500 for the trading week ending Friday, 3rd of April 2020. I'm expecting this correction to continue into next week. It looks like it may continue to be quite shallow. So far it's finding resistance at the very or highly technically significant trend channel for a very typical bounce and back test. The trend remains down. This is a bear market and the target for it to end is quite low. When this correction is done, I'll be recalculating that target. The target for it to end so far is at 1708, but when I know where B has ended and C has begun, this target may change, because when I know where C begins, then I can add to the target calculation at a second degree. So far the target is for cycle 2 to reach 0.618, the length of cycle 1, and I will also now be publishing a more bearish wave count on a daily and weekly basis. This wave count sees the bull market over here as a 5-wave impulse, and I'm labelling it for this wave count cycle wave 1. If cycle 1 ends there, then cycle 2 begins here, and it would most likely subdivide as a zigzag, although it could be any corrective structure except for a triangle. So far it does look like it's a zigzag. From this high to this low, this downward movement looks like an impulse and subdivides very well at lower time frames as a 5-wave impulse. And so I'm going to label this for now primary wave A. It's also possible that we may need to move the degree of labeling here down 1 degree. It's also possible that primary A may be incomplete. But so far let's consider this as primary A, because the rule is the same. If this is A and this is B, because A most likely subdivides as a 5, B may not move beyond its start above the invalidation point. If we move the degree of labelling down and label this 1 and 2 within A, the rule is the same. 2 may not move beyond the start of 1. So for the short to mid-term, it makes no difference to the subdivisions and the invalidation point, but it is something I'll need to consider in coming weeks. This trend channel is highly technically significant. It's very important. I'm giving you the exact daily candlesticks, the date and the price points from which to draw this channel on the daily and weekly charts. It's drawn from 1 to 3 with a copy on 2. Those points are off to the left of the chart. The lower channel, lower edge of that channel, when drawn in that way, perfectly shows where 4 found support, and it's perfectly showing where the last 2 weeks have found resistance. This looks like a typical breakthrough and a bounce to back test resistance. I am expecting B is quite likely to continue sideways, and let's assume, until proven otherwise, that B is likely to find resistance at this trend line, which means it could be a relatively shallow bounce. When B is complete, I'll then expect C to begin down, and C must subdivide as a 5-wave structure. Cycle 2 may not move beyond the start of cycle 1, which for this wave count is the beginning of the bull market in March 2009 at this price point. Let's take a look now at the daily chart, where the high for cycle 1 is this point up here. Here's primary A as a 5-wave impulse. 1, 2, 3, 4, 5. The channel around it is breached. I am expecting now that primary wave B is likely to continue sideways for at least another week or 2, and may unfold as either a flat, combination or triangle. And I'm giving, for daily Elliott Wave members, I'm giving those different possibilities at the hourly chart level. A flat, a combination and a triangle, I'm also considering a zigzag. A flat, combination and triangle would expect primary B would most likely continue to find resistance at the lower edge of this channel, and so one of those structures is most likely correct. The most important point at this stage about primary B is it's most likely to be incomplete. When it's complete, then I'll expect primary C down. And so I'm expecting a fairly wide-ranging sideways consolidation with swings from resistance to support and back again before eventually a downward breakout and the bear market to then resume. I'm going to separate out the flat, combination, triangle and zigzag possibilities for primary B now into different hourly charts, because the subdivisions are now quite different. This first chart considers primary B as a flat correction. Flat correction, subdivide 3, 3, 5, and within them, the B wave must retrace a minimum 90% the length of the A wave, for this example is at this price point. Expanded flats, C wave B, which moves beyond the start of A. Intermediate B could make a new low below the end of primary A here and the start of intermediate A at this point, and this wave count would remain valid. There is no lower invalidation point for this reason. Intermediate B must subdivide as a corrective structure. It can be any Elliott wave corrective structure, including a multiple. So far, I'm going to label it as a possible zigzag. That's the most common corrective structure, so the most likely. And so far, that looks like what it may be subdividing as 5, 3, 5. When intermediate B may be complete, depending on its length, if it reaches the minimum point that is, then that would tell us what kind of flat primary B may be unfolding as. Within intermediate B, minor B may not move beyond the start of A above the short-term invalidation point. The second chart considers the possibility that primary B could subdivide sideways as a triangle with a double zigzag for A, a single zigzag for B, and then C, D, and E most likely. 4 of the 5 subwaves of a triangle must subdivide as single or multiple zigzags, with only one subwave allowed to be a multiple. If intermediate A is a double zigzag, that means all of the remaining subwaves of a triangle must be simple corrective structures. Almost all of them, or almost always, that means they'll be zigzags. Intermediate B may make a new low beyond the start of A as in a running triangle. 40% of triangles will do that, so if this is a triangle, there's a 60% probability that B will not make a new low beyond the start of A. But it could do so, and so there is no lower invalidation point for this wave count for that reason. When B is complete, then C of a contracting or barrier triangle may not move beyond the end of A, and then D may not move beyond the end of B for a contracting triangle. For a barrier triangle should end about the same level as B, and then E may not move beyond the end of C. An ever decreasing range with sideways movement for another couple of weeks or so is possible if primary B unfolds as a triangle. Alternatively, it's again possible that primary B could be subdividing as a double combination, zigzag, X, flat correction. Within a double combination, which are fairly common corrective structures, there is almost always one zigzag and one flat correction. The other two possibilities are other two structures are a zigzag and a triangle. If intermediate A is a zigzag, this subdivides very well. Intermediate X could be a flat correction subdividing 3, 3, 5, and intermediate Y could be a flat correction subdividing 3, 3, 5. Intermediate Y would be most likely to end about the same level as W, so that the whole structure takes up time and moves price sideways. That's the purpose of intermediate Y. Well, its purpose is to take up time and move price sideways. And so it may continue to find resistance at the lower edge of that really important multi-year channel. And finally, considering the possibility that primary B could still be a zigzag, this wave count has the lowest probability because it would most likely require resistance at that multi-year trend line to be overcome. And we should assume, because it's been tested for the last 2 weeks and it's holding, which increases its technical significance, we should assume that that resistance will hold until it doesn't. If it gives way, then this is a good wave count to show a possible pathway for how price may then behave. If primary B is subdividing as a zigzag, then A must subdivide as a 5-wave structure, B could be an incomplete double combination, and then C would need to subdivide as a 5-wave structure to move beyond the end of A to avoid a truncation, and possibly to take price closer up to the 0.618 Fibonacci ratio. Intermediate B may be a double combination, flat correction for minor W, zigzag for minor X, and a zigzag for minor y to end about the same level as minor w to take up time and move price sideways. If intermediate A subdivides as a 5-wave structure, then intermediate B may not move beyond its start below the invalidation point. This is the only hourly chart at this stage which does have a lower invalidation point, and this hourly chart has the lowest probability so far. This one has possibly an even lower probability. There is not enough strength in downward movement yet to give an indication that primary B is over. But in the spirit of considering all possibilities, I do want to consider this. It would see primary B as a relatively brief and shallow double zigzag. This is possible. The Elliott Wave structures all fit and it makes sense, but it is a very brief and shallow primary wave B. Primary wave B is a double zigzag. The first zigzag in the double is labelled intermediate W. The double is joined by a quick shallow 3 in the opposite direction labelled X, and the second zigzag in the double has moved beyond the end of the first, achieving its purpose, although it really didn't do so by much. So it does fit, but it doesn't look very typical. If primary B is over and primary C is underway, we can then apply the Fibonacci ratio between primary A and primary C to calculate a new target, which I've done here. For primary C to reach 0.618, the length of primary A. Primary C must subdivide as a 5-wave motive structure, and so far within it, intermediate 1 may be incomplete, with minor 1 and minor 2 may be over here. It could continue higher as a double zigzag, and if minor 2 does continue higher, it may not move beyond the start of minor 1 above the invalidation point. This wave count is invalidated by any amount at any time frame above this price point, even a fraction of a point on a tick chart. It doesn't have to be on a closing basis. That's a common question. Alternatively, if we move the degree of labelling within the entirety of the bull market beginning March 2009 all up 1 degree, then instead of just wave 1 within supercycle 5, the whole of supercycle 5 could be over. We could have seen a grand supercycle trend change just a few weeks ago. If this wave count is correct, then an absolutely devastating bear market may have just begun. This is absolutely possible, and I think we need to consider all possibilities. It would have absolute confirmation if we have a new low by any amount at any time frame below this price point. This is the beginning of the bull market in March 2009. That would invalidate my first daily chart. If this wave count is correct, then we have had the start of possibly the biggest bear market in history after absolutely zero divergence between price and breadth, well, almost zero divergence between price and breadth at the all-time high. This is possible, but the probability is lower because there is a positive correlation between the length of breadth and the severity of the following bear market. The length of divergence between price and breadth and the severity of the following bear market. A greater, longer divergence has a positive correlation with a more severe or deep bear market. Little to no divergence has a positive correlation with a more shallow bear market. And so statistically, based on breadth, or the lack of divergence here between breadth and price, this wave count does have to be judged to be an alternate with a lower probability. Lower probability does not mean no probability. This is a possibility that should be considered. If there is a new bear market at grand supercycle degree, it may be expected quite reasonably to last several years, at least possibly a decade or longer, and it would reasonably be expected to move reasonably below this confirmation point. The first target is for cycle wave 3 to reach 1.618, the length of cycle 1. Cycle 2 here is labelled as possibly a complete double zigzag that will fit at lower time frames. This labelling assumes it would be brief and shallow, finding resistance at the lower edge of this multi-year channel for a typical bounce and back test. Cycle 2 may not move beyond the start of 1 above the invalidation point if it does continue any higher. At the hourly chart level, here's the possible end of cycle 2 and the start of cycle 3. I'm labelling minor 1 incomplete with minute 1. Minute 2 may be over here. It could continue higher. If it does, it may not move beyond the start of the invalidation. It may not move beyond the invalidation point. Now that the month of March is complete, we can analyse it. Here's the month of March, and it's got huge volume, actively pushing price lower. There's a long lower wick on this monthly candlestick, and there is a bounce when we look at this at lower time frames. I'd expect price to possibly find resistance in the first instance at this trend line here on this chart, although the trend channel on the Elliott Wave charts has better technical significance. It's drawn slightly differently. At the all-time high, there was double bearish divergence between price and RSI. There was a shooting star candlestick at the monthly chart level as well, a bearish reversal signal. On balance volume has broken below support, giving us a weak bearish signal. ADX at the monthly chart level indicates a downward trend which has got a long way to go before it becomes extreme, and ATR is rising, which is normal behaviour for this market when it has downward movement. From the inception of the bull market back down here, in March, which is one candlestick off to the left, March 2009, this bullish movement has come with consistently declining volume, which tells us that support below is weak, particularly at higher price points. The lower we get, there will be a little bit more support. All the textbooks tell us that this is unsustainable, but it has been obviously sustained for over 10 years. Now that a bear market has arrived and that the bull market is over, this bear market could move with a lot of speed and strength because there isn't a lot of support below to hold up price. So that's a really strong warning that this bear market could move really fast. It will be corrections and consolidations along the way within this bear market, because price does not move in a straight line. This is the weekly chart. We're looking now at this bear market. Here's a breakaway gap, a strong downward movement, a bullish engulfing candlestick pattern with a long lower wick. Last week told us to expect a bounce or consolidation. That's what we're getting within this bear market move. This week completes an upward week, but it doesn't have support from volume, and so this looks like a typical counter trend week. The trend at this stage is very obviously down. So when I talk about counter trend movements in the context of a bear market, obviously I'm talking about upward movements. Bear markets do not move in straight lines. They will have bounces and consolidations along the way. Those will be corrections within the bear market. We are in a bear market at this stage. ADX indicates that there is a downward trend. Price has retraced more than 20% of market value, meeting the technical definition of a bear market. There is not enough evidence yet to indicate that there is a sustainable low in place, and weak volume for an upward week this week would be concerning for bulls. This looks like a counter trend movement or a pause within an ongoing bear market. On balance volume has a new range. It's a weak range. It's just moved down from resistance for this week, giving us a very weak bearish signal. RSI has been brought back into neutral territory by this bounce. We've been over ADX. MACD is full ball bearish. We've been over ATR. At the daily chart level, there are 8 90% downward days in this bearish movement. This is a very, very strong and convincingly strong bearish movement. Following that, we have a V bottom, a 90% upward day, and followed immediately after by 2 back-to-back 80% upward days. It is just possible that this could be a sustainable low in place. However, this week we got a 90% downward day. It would be really unusual if this is a sustainable low to quite soon after see another very strong downward day. It's not strong in terms of range or volume. Volume was relatively weak, but it is strong in that it was a 90% downward day. A 90 or 80% day means that 90% or 80% or more of volume plus advances or decliners meets the criteria. So for a 90% downward day, 90% or more of total up-down volume needs to be needs to be down, and total advances and decliners, 90% needs to be total decliners. And so those are the two criteria for a 90% downward day. I hope I've explained that clearly enough. I don't think that was, sorry. Volume is declining as price is moving sideways. This looks like a pause within an ongoing downward trend. And this 90% downward day quite strongly tells me to expect this is a counter trend movement within an ongoing bear market and not necessarily the start of a sustainable bull market to new all-time highs. ADX reached very extreme for the downward trend. It's now declining, telling us that trend may have ended at the weekly chart time frame. ATR is declining as price is moving sideways. That's normal for a pause within a trend. On-balance volume is constrained at the weekly chart level. A breakout here would give a signal. I'm not going to give weight to this long-term bullish divergence because it doesn't tend to be as reliable to how on-balance volume behaves with its trend lines. I will give a little bit of weight to this double bullish divergence between price and RSI at lows, and that, in conjunction with this 90% upward day, told us to expect that there was at least an interim low in place, and that's what we're getting. We're getting some consolidation. That's exactly what should be expected. RSI is in neutral territory. There's plenty of room for price to rise or fall. I will not expect it to get overbought though before the bounce ends. It may only end still in neutral territory. MACD is bullish but not fully so, and stochastics in neutral territory. This week at the weekly chart level, price has moved higher but the AD line has declined. This is another reason why I'm expecting that we don't have a fully sustainable low in place, that we're probably just seeing a counter-trend movement within an ongoing bear market. The AD line has made a new low, price has not made a new low. Price has moved upward this week, although the candlestick was red, the AD line has moved lower. Within upward movement this week, breadth has declined. There is more strength to the downside from market breadth here this week. This is bearish divergence. At the daily chart level for Friday, prices moved higher with a slightly higher high and a slightly higher low. Although the candlestick was red, the AD line declined. There was more pressure to the downside within Friday's session than upward from breadth. This divergence for the short term is bearish. This week, prices moved higher with a higher high and a higher low. Inverted VIX has also moved higher with an upward movement this week. There was a normal corresponding decline in VIX. No divergence this week. For Friday's session, price moved higher with a higher high and a higher low. Although the candlestick did close red, inverted VIX moved higher also during Friday's session. Upward movement within Friday's session comes with a normal corresponding decline in VIX. There is no short-term divergence at the daily chart level. Last week I took some time to have a look at bounces within the dot-com crash, and this week I'm going to take some time to look at bounces within the global financial crisis, which began in October 2007 and ran right through into March 2009. I'm splitting it up into two daily charts so we can look at the candlesticks a bit more clearly. Here's the first bounce. It ended 31st of October 2007 and it lasted just 5 days. Right after the high, there was a strong bearish engulfing candlestick, which did have support from volume. ADX declined throughout, ATR was overall flat, and on-balance volume confirmed highs at the end. RSI exhibited no bearish divergence. The second bounce ended 11th of December 2007. It lasted 11 days. There was a very strong bearish engulfing candlestick at the end, which did have support from volume. Volume declined throughout. ADX indicated an upward trend right at the end of the bounce. ATR declined throughout. On-balance volume exhibited no divergence and confirmed highs at the end. RSI did not exhibit divergence at the end and it didn't reach overbought. The third bounce ended 1st of February 2008. It lasted 7 days. There was a dark cloud cover candlestick at the end, not quite a bearish engulfing, but kind of close. It was a strong dark cloud cover, but it did not have support from volume. ADX declined throughout. ATR was overall flat. On balance volume confirmed highs at the end. RSI didn't reach overbought and exhibited no bearish divergence. The next bounce, ending 19th of May 2008, was much longer in duration. It lasted 44 days, and there was an evening star candlestick with a shooting star almost at the end. The third candlestick did have support from volume. Volume declined throughout. ADX indicated an upward trend in the middle and again at the end of the bounce or correction. ATR declined throughout, and on balance volume confirmed final highs. There was single short-term bearish divergence between price and RSI at the end, and RSI did not reach overbought. The fifth bounce ended 11th of August 2008, and it lasted 19 days. There was a fairly weak bearish engulfing candlestick at the end. It didn't have support from volume. ADX declined throughout. ATR was overall flat. On balance volume didn't so much exhibit bearish divergences. It was mostly flat at the end. And also note, after this high, as price starts to move lower, on balance volume is exhibiting bullish divergence, and so that's one reason why I'm not going to give that much weight. I'll use it with trend lines rather. RSI did not reach overbought and didn't exhibit any divergence. The next bounce, labelled number 6 here, ended 4th of November 2008. It lasted 17 days. It was followed by a very strong bearish engulfing candlestick pattern right after the high, but it didn't have support from volume. ADX declined throughout. ATR declined throughout. On balance volume, it did not exhibit bearish divergence. It did confirm new highs at the end. RSI didn't reach overbought and exhibited no bearish divergence. The bounce labelled number 7 ended 6th of January 2009. It lasted 29 days. There was an evening star candlestick at the end. Volume declined throughout except right at the end, showed a little bit of improvement, but overall the pattern for volume was overall down. ADX declined throughout, ATR declined throughout, on balance volume, overall flat, did not confirm final highs, but didn't exactly exhibit much bearish divergence. RSI exhibited no bearish divergence and did not reach overbought. The very last consolidation here, sideways consolidation, I'm counting it from this here to this here, lasted 13 days. There was an evening star candlestick at the end. It had strong support from volume. ADX declined, ATR declined, on balance volume confirmed final highs. RSI did not exhibit bearish divergence and did not reach overbought. Just going back to the first chart, you can note that within some of these bounces, for example this here, there are candlestick reversal patterns, and yet that wasn't the end of the bounce. So the presence of a candlestick reversal pattern like this huge bearish engulfing candlestick, which didn't have support from volume, but the presence of a candlestick reversal pattern, it improves the probability of a more sustainable high in place, but on its own, although it's one of the strongest signals, it doesn't necessarily mean price can't bounce further. There's a bearish engulfing candlestick pattern here and another one here as well. Within the early days of this bounce, there's another one here as well. And if we get to the next chart, there's some further examples. Here's an evening star with a bearish engulfing candlestick pattern. There's a huge bearish engulfing candlestick pattern here. And there's a bearish candlestick pattern here as well within this consolidation. So the conclusion here from this bear market could be that major bounces can last from 5 days or as much as 2 months. At the end of every bounce there should be a bearish candlestick pattern, but it doesn't mean if one turns up that the bounce has to end, only that if there is an absence of a bearish candlestick pattern, the probability of the bounce being over is quite low, so it should be looked for. We should expect ATR to be flat or declining throughout. On balance, volume will often confirm highs at the end, and RSI very rarely will exhibit bearish divergence at the end. That's all from me with your S&P analysis this week. I hope all our members are having an awesome weekend, and I hope everyone is staying healthy and sane and well.